everyone, welcome to our webinar for First Time Investor Masterclass. My name's Danielle. I'm joined with my colleague Tahana. So just wanted to introduce ourselves to you. So I'm a portfolio manager here at Real Estate Investar. I have over 500 clients and 9 years of investing experience. Recently I acquired 2 off-the-plan properties and I have my current real estate license. Tahana Payne, she's also a portfolio manager with over 500 clients, so very busy here. She has a bachelor degree in real estate and property development. She's also a member of the Urban Development Institute of Australia, and she's studying for her real estate license also. Just a little bit about Real Estate Investar. We have over 3,000 current subscribers, and that's a mix of personal users, accountants, buyers agents, brokers, real estate agents. We also have 250,000 plus members that use us for calculators, investment news, market information, and other property updates. We are listed on the stock exchange, so we do have a heavy investment in our product, and we also have a strong and focused board made up of Simon Baker, who is the former CEO of realestate.com, and Anthony Catalano, who's the CEO of Domain. We are in partnership with a number of companies that you can see: Domain, Xero, Local Agent Finder, APM Price Finder, just to name a few. Now, our mission here is to provide property investors around the world with the best advice as well as guidance and products and services to enable them to create wealth through property investment. So what we wanted to start with today was setting achievable property investment goals. So first you need to identify what is your actual goal, what is it that you're looking to achieve, and how do you want to achieve that goal? Is it reasonable to expect that you can complete that goal? Do you have the time? Do you have the knowledge? Do you know how to go about finding all of this information in order to purchase the right property for yourself? Some tips for you: start at the end. So identify where you're at now, think about the steps that you need to take in order to reach your goal. And your goal should be comprised of several smaller goals, and it's always a good idea to write those out. And a lot of problems that people have is that they just don't get started. So that's the number one reason that they don't get to their end goal. So we thought it would be best to start with choosing a strategy. So you've probably heard this before, but property investing should be first and foremost an unemotional purchase. And remember that you do have finances apart from your initial purchase cost, so you need to know what you're committing yourself to. So consider your stamp duty, which is anywhere from 10 to 20,000, sometimes more. You also got your solicitor's fees, which is on settlement, your council rates, which is quarterly costs that you have to consider, and also any repairs and maintenance as required. There, of course, are more costs apart from this, but these are just some to name a few. You need to think about what you want to achieve from your investment property. So for example, are you looking for cash flow or passive income, so something to add to your current salary? Are you looking to accumulate equity so that you can purchase more property? Or did you want to buy a renovatable property, for example, and manufacture growth? Or are you thinking about replacing your income by a certain date? So for example, you're looking to retire in the next 10 years, or just for something to assist with your retirement. So we wanted to cover off a few strategies today, and they are cash flow, discount, and renovation. So cash flow is where the renters come in, you've paid all of your expenses and loan repayments, and you end up with money at the end of that, so you're not putting into your pocket. Discount is where you can purchase property below market value, and this is usually through a mortgagee or a deceased estate, a divorce, maybe the owner's bought overseas and needs to sell urgently. You've also got your renovations, so purchasing a property that might be run down or outdated. You could do a cosmetic renovation to it to spend a little bit of money, or even if you wanted to do a whole structural renovation, and therefore you can increase the equity and the value of that, and whether that's to rent it out at a higher rate than when you first purchased, or to sell it and to make a lot of money quickly. So think about, what are your goals? We hear this a lot where people say, I want to have 10 investment properties in the next 10 years. You need to really do the numbers here, guys. It may not be financially viable for you to just purchase 10 properties. So if you're choosing the wrong property, if you don't analyze the numbers, you can really feel it in the long run, and it may not be viable for you. So I've just done an example here. You can see you've got a column that says negatively geared and positively geared. So I've just put in a purchase price of $400,000. So assuming that you're spending $400,000, it does matter where you buy, what the capital growth rate is, what sort of rental income you can expect to achieve. So I've just put in some numbers there. You can see the growth rate in the negatively geared column is quite low at 2%. The rental income's at $250 per week. So just remembering, because you're still getting rental income doesn't mean that your expenses are going to be inclusive of what sort of cash flow you can achieve. So I've put in there the cash flow per week on a $400,000 property with those figures is minus $47 per week. So every week you'd be forking out $47. With this property, if it's positively geared at 6% growth, and you've got your rental income at $550, you're looking to gain $147 per week. Now, I mean, if you were looking to spend $47 a week, it obviously doesn't sound like too much. However, if your long-term goal is to purchase 10 properties in the next 10 years, have a look at that bottom line there. I've done the calculations for you. So if you were to have 10 of these properties per annum, you'd be spending over $24,000 per year. So I don't know about you guys, but I don't have that sort of cash to be spending just to have property. I would rather have property that's going to make me money. So if you look at the next column where it says positively geared, there you're earning yourself $76,500 per year. So that could replace your income or add to your income, or add to your retirement fund. All these things that you need to consider when you're looking to purchase property. So think about your goals. So as I mentioned, you can replace your salary, retire by a certain age, and you can also purchase multiple properties over time if it's cash flow positive. Now, if we're looking at discount, here's an example of purchasing a property that is market valued at $500,000, but we're going to buy it at a discount of $400,000. So just have a look at the two columns there. You can see if it was bought at discount price and bought at market value, what the difference is. So you can see your equity from day one is $163,000 bought at the discount price, but if bought at market value, it's $83,000. So almost half of that. You can also see the equity in 10 years is about 80 grand difference there, and your surplus equity to reinvest from day one. So this is where you can use the funds to purchase another property, and you've got $63,000 in surplus equity from the day of settlement. So once you've purchased it, you've got those funds available to buy another property. However, if you were to buy it at market value, you wouldn't have that. So it's a little bit more flexible when you're buying it at a discount. You also got a difference of the loan repayments as well, buying it at market value versus discount of about $3,500 there. So why would you purchase a discount property? A few reasons. You've got, if there's a lack of funds to purchase a full price property in an area, you can get into that area at a good deal. You can enter the market below median, so you have the opportunities to manufacture growth. You can increase your cash flow at a reduced price. You can also save money for short and long term. So the other strategy we wanted to have a look at is a renovation. So this particular example is one that we presented for our premium clients. So you can see here the purchase price was $260,000. We did a small reno, so $10,000 was the cost, and it was revalued at $350,000. So The equity growth in that deal was over 68,000, and that was not with a lot of work, as you can see, $10,000, so not too much was done there, but the growth that was manufactured was pretty astounding. So again, with your reno property, why would you purchase? If you had a lack of funds, again, to purchase in full price property in an area, again, entering a market below the median, accumulating equity so that you can purchase more property, so whether you wanted to buy it to on-sell it or just to rent it out at a higher rate, and to manufacture growth is the more obvious one. So we've got our 5 stages of investing. So you've got your finance. Obviously, you need to know what your borrowing capacity is before you can even think about the area that you want to buy in, or what sort of property to purchase. You need to know how much you can borrow and identify the areas where you can purchase property and the markets are going to work for you. So we'll go into more detail with this in the upcoming slides. The next stage is location. So this will be based off your strategy and of course your borrowing capacity. So if you're just starting out and you have limited funds available, you probably won't be purchasing in the Sydney CBD, for example. There are things that you need to consider, obviously. So with your any schools or TAFEs or universities nearby, it obviously is helpful if there's surrounding infrastructure. What type of lifestyle would the property offer? So your cafes or shopping or any sporting facilities. Does the local council have any plans for that area that might impact the property? All these things that you need to think about. Also got the type of property that you're looking to purchase, so do your research on the area and its demographics and educate yourself about the needs and lifestyle of the potential tenants that may look to move in there. Market research is next, so again, remembering that this purchase should not be an emotional one. It isn't like buying a home where you're looking at the kitchen or you're looking at the backyard and think, my family could grow up here. It's not like that at all, just bear that in mind. And the next stage is, of course, the contract of sale. So this is where you would contact your solicitors, and we'll go through that in more detail also. Okay, so set up a team of experts to help you through this process. So you want to speak with your accountant, you want to employ the services of a solicitor or a conveyancer to assist with your contract of sale. Also a broker to help with your finances, a property manager that's going to assist you when you want to rent out the property. And you've got your friendly portfolio managers at Real Estate Investar that can help you through the way also. So the pros and cons of contacting a broker. So you've got the pros, which is you can negotiate with mortgage lenders based on your circumstances, so that there'll be a number of different products that you have the option of going with. They'll present a short list of the best available deals for you, and they will translate the financial jargon so that it makes sense and advise you what would be best for you. So the cons there is that they do rely on their contacts, so they may offer a limited range of products. The brokers get commissions from lenders also, so they may have their favourites that they want to go with. And if they're non-commission paying lenders, even if they have the best deals, they may be ignored. Okay, so if you wanted to go through your bank, we've just listed some pros and cons here. So the pros, you have a loan officer that will match you with the best product available internally, so within their financial institution. They have experience working with their bank and other policies and loans within that. Sometimes they have lower interest rates. With the cons, there are no competitors, so there are less options available, obviously, because they're only dealing with their own institution, so they can't look anywhere else to see if there's better deals. They don't disclose any yield spread mediums and premiums and the potential for being overcharged, so they're not transparent with their commissions. Okay, so we've come to the negotiation part. So what we want to go through is the steps to negotiation. So understanding the method of sale, preparing to negotiate for the right deal, assessing the seller's situation, what to do at the negotiating stage, and preparing to close the deal. So understanding the method of sale. So generally you've got your auctions. Have a look at the area that you're looking to purchase in. You might find that some areas are very auction heavy and that might drive up the price. That's why they do it. Whereas your private sales, the competition that the agents talk about can sometimes just be you up against yourself. So really have a look into this when you're looking in a particular area. Preparing to negotiate. So here is where it's very important for you to do your homework and your research. We'll go through this with our tools a bit later on. So speaking to people, whether that's your buyer's agent or a solicitor or even family and friends, to just get assistance with negotiation. You'll know a lot of people that have purchased property before, I'm sure, so it's always a good idea to find out what their experiences have been and how they've found the negotiation process. Also looking at sales comparisons of similar properties sold over the last 3 months, 6 months, and also 12 months can be very helpful. Always recommend to organise a building and pest report. And the reason for this is, first off, you want to know that you're buying a property where there's no structural issues, but also if there is, it's a good way to negotiate and can provide you with leverage. So assessing the seller's situation, this is a good example, particularly if we're looking at discounts, discount price properties. You've got the death, divorce, debt, disaster, all those sorts of situations where the seller might be desperate to get out, so they might reduce the price even further just to get rid of the property and so they can move on. So locating distressed vendors is a good way of finding a good property where you can negotiate down. And if you ask the questions like, why are they selling? Have they purchased another property? So you know how quickly they want to move. What settlement terms do they prefer? Have they had any other offers? And how long has it been on the market? So Tana will go through that one when we go through the demonstration a bit later on. What to do at the negotiating table. So you must be prepared, guys. I can't stress this enough. Always aim 10% below the estimated market value of the property. So if you start lower, you have room to negotiate up. You do not want to play your final or your best offer right at the beginning, because you'll box yourself in, you have nowhere to go. And also just think about the fact that 5 to 10% difference can provide instant equity. So it could mean that you're purchasing sooner, or it could fund your lifestyle. So preparing to close the deal. You must have an upper price limit. So think about where you want to start with your negotiation, where you want to end at the absolute most. Be prepared to walk away from the deal if you're going to be spending too much on it. Okay, use the terms of your offer to negotiate, so your price, your settlement terms, deposit, conditions, and make the offers as unconditional as possible. That creates a win-win situation. Increasing the chances of closing the deal will be obviously having your finance ready to go. So you might have a property in mind and you're keen to go ahead, but you haven't spoken with your broker, so you don't know, you don't have any pre-approval, but you could be competing against a couple that already has pre-approval ready to go. They can go to the bank today and get a check to put a deposit down, so you're automatically going to miss out on that deal. Obviously doing your building reports and contract approvals first. Have a backup property to use as leverage. This can sometimes help as well. So when you're speaking with the agent, let them know that you've got another property that you're looking at. Find out if there are other offers and the terms, and presenting the offers in writing with a 10% deposit check. Okay, so assuming that's all gone ahead and you've negotiated a great deal for yourself, you're next up at the settlement process. So this is a complex legal process, and as I mentioned before, I would definitely recommend the services of a solicitor or a conveyancer to assist you. They know all the legal jargon of the contract of sale for properties that we don't come across every day, so it's much easier for them to let us know if there's anything that stands out in the contract, or if it's a standard contract, and they're happy to proceed as is. Now the settlement period, it can vary, but typically it's around 30 to 90 days. And settlement day is when the ownership of a property is transferred to you, and that's when you pay the balance of the sale price. And once settlement's complete, you can collect the keys and the property is all yours. So by the time you've decided to put an offer on a property, you would have already engaged with a broker or bank. There we go, he's all listening. And you need to organise all the money that you need to complete the sale. So that includes any lender's mortgage insurance, your stamp duty and other fees and charges. So as I mentioned, contacting a solicitor or conveyancer to act in your agent is within your best interest. So the sales contract is signed and dated, you organise your building and pests, you organise all your insurances and make sure that you do complete a final inspection of the property before settlement. So this is important. You want to make sure that when you did put an offer on the property, that's the property that you're getting, that there's been no changes, no damage to the property since then. So it's really important to do your final inspection. Okay, I'm going to hand over to Tahana to talk about how to boost your rental income.
So being able to increase your rental income is obviously a skill as an investor that will help you increase your return on your investment. And of course, it's not something that always comes naturally to people, so we've compiled a couple of different ways that you can do that. So charging market rate rents. In order to make, well, you may have great tenants that pay their rent on time, but in order to make the most out of your investment, you will need to increase the rent from time to time. By not reviewing your rental rates, you could be missing out on additional money or funds. So think about losing out on $25 per week. At the time, it doesn't seem like much, but that's around $1,300 per year. Now, that's not going into your bank account. So remember, if you think your tenants will leave due to a rate increase, they'll only move into another property that is charging the same. So do not be scared to increase the rent based on current market rates. Re-evaluate your property manager. So it is always worth shopping around for the best deal. Find out what other agents, property managers can offer and what they charge for their service, and re-evaluate what you're getting out of the current property manager. Remember to get a full statement of your services and your costs, just so that you know how much you're paying on an annual basis. So for example, you may be able to negotiate a 1% decrease on management fees. However, that property manager may then charge you for, your fire alarm servicing, contract reviews, double the letting fees, etc. So get a breakdown of the costs so you can see the value and of course how much you'll be saving per annum. Also, here you can ask your property manager for advice on how to increase your rental income. So they spend at least 5 days per week reviewing properties and renting out properties. So they know what the market looks like and how it is. So they also know what tenants want. Ask your tenants. For those of you that have good tenants, long-term stayers, or even those that have just had some tenants move in, don't be afraid to ask the question, is there anything I can do to the house that's lacking? In this instance where they provide suggestions, advise to them that it will cost you money to do so, and you would need to increase the rent for those modifications if they're happy to do that. So by talking to your tenants and finding out what they want, you can increase your rental income and get a better return on your investment while also updating certain things on your property. A great way to do that is by adding an air conditioner. So for those properties where there is no air conditioner, you could offer to install one and increase the rent by around $20 per week. So now $20 per week works out to be around $1,000 a year, and you don't necessarily need to spend a lot of money on the air conditioner or to do this. So if you shop around, you can easily pick up an air conditioner for under $1,000, and you could make your money back in a year or less, and also adding additional value to the property. Do a quick kitchen makeover. So we don't want you to spend $10,000 or $20,000 on a complete kitchen makeover, but there are simple things that you can do to make your kitchen look new without spending a lot of money. So replace things like handles on the cabinetry. A lot of older kitchens have really old handles. You can replace them with brand new stainless steel ones that look great and will automatically make your kitchen look more modern. You can paint your kitchen, so consider painting over outdated colour or old timber grains. Stick to a crisp white to spruce up the kitchen, and even replace your bench tops, so you can get partial marble bench tops that are very affordable and create a new feel to the kitchen without spending a fortune. Replace the taps in your sink, so updating the taps, adds to making the kitchen look more modern, and look at what's going to be bringing in the best return and make the biggest effect to your kitchen. So by spending a minimal amount, you will increase the value of your property in the short-term period. Do a bathroom makeover. So it doesn't necessarily have to be structural. If you have a property where the bathroom is dated, consider painting the tiles white or neutral to bring the colour, the bathroom back to life, and consider getting new handles and new taps for the vanity, or even replace the vanity if you have the money to do so. There's no harm in going onto places like eBay, Gumtree for used materials that you can then, I guess, revamp and turn into something a bit new. So add a fresh coat of paint to the house. This especially works when you've got a property that does not have neutral colours or outdated wallpaper. So you might have a property where each room is painted a different colour. When this happens, you're going to turn away some potential tenants. So if you have potential tenants coming through your property with a big bright pink bedroom, you are limiting yourself to the tenants that will want to rent your property out. It might be great if you've got a family with young girls, but think about two guys that might be looking to move in. Neutral colours attract more people, and you want to appeal to the majority rather than a minority. Refresh the flooring. So think about new carpets, new floorboards, and new floating floorboards. You can pick up the floorboards that click together for a bargain, and they look fantastic. So you can even install them in the house yourself. You don't necessarily need to spend a lot of money on the tools, let alone the labour. And if you've got old stained carpets, it's a good idea to look at replacing it, which is relatively cheap depending on how you do it. Convert a garage into an extra room or living area. So depending on the area that you're in, you may have a 3-bedroom house and you are competing with 4-bedroom houses. So consider converting a garage into an extra bedroom or even a living space. Think of the extra rental income that you could command, and you would need to check with local council as to whether or not you are allowed to go ahead with a conversion like that, but it may be something you can do that's cost effective to add an extra room to the house and then put you in an extra price bracket in terms of getting extra or additional rental income for that property. So what I've done here is I've actually gone through and looked for a discount property using the tools. So using Investor Search, I've input three types of filters here. So looking within a 30-kilometre radius from the Brisbane CBD for keyword strategies, discount, and properties that are at least 10% below median price. So we managed to bring back over 1,000 matching properties that met those requirements. We've got a median price of 82.9%, which indicates that it's roughly around 17% below median price, which is actually $625 for 3-bedroom houses in Elderly. So once we've found the property, really quickly you'd go through to do a valuation report, or at least get a bit of a better idea about the market within that area. So for 48 Samford Elderly, we'll enter that property into the report area, and we get a market estimate of $620,000 back. So that's identifying that the property's been listed at $518. The market estimate is around $620, so there's about $102,000 difference between it. And our last sale amount, so what they purchased the property for back in 2010, was $386,000. So if we look at the sales history, we can see how long the property's been listed for sale for. And of course, this ties in with your negotiation tactics. So if a property has been listed for some time, it's obviously going to be a tactic that you can use in order to secure perhaps a discount on the property. They're more likely to sell at a discounted rate or have the propensity to negotiate on price. Sale history. So what I've done here is I've had a look at property sales within the area in the last year on under 500 square metres that were 3 bedrooms, and it brought us back a median statistic. So we can see that the median price of properties sold within that area was $585, and we've got our price variance between $560 and $685. So we know that this property has been listed significantly below the median, and of course below value price. So we'd have to then do a bit more research and obviously enter negotiation with the real estate agent if we were interested. So for those properties that did sell, we can see that it's all centric to the train station in that area, and of course this ties in with what's important in terms of boosting your value or your capital. So in terms of looking for properties, you'd want to be looking for things that are close to supporting a local infrastructure. In this case, we've got a train station just down the road. in Outerley, and it's also close to your army base. So think about your potential demographic that may be moving into that area. So in this situation, what I've done is I've exported documentation or files from the sales in that area over the last year, and we've looked at, what I've done is I've data sorted to look at the agents within that region. So agents that negotiate are your friends. Get to know them, whether that be through person-to-person communication that you have with them or research. So in this situation, I've had a look at Janine McDonald, and we can see that 2 of the 5 properties that she sold, she reduced the original asking price. So in this situation, it's giving us a bit of an idea about potential real estate agents that we could be dealing with, whether or not they have the propensity to negotiate. And of course, if you're looking at doing some sort of flip or selling the property in the future, this is always something that you may use to do your market research on agents without just relying on the photos that they have on bus benches. Approximating rental return. So if you're looking at holding onto the property for cash flow, you'll be looking at getting a bit of an idea about what the median rental return is for properties in that area. And we can see that the median rental return for this particular property, or that type of property, 3 bedrooms, is around $550 per week. So at this stage, we've identified that the value of the property is around $620, asking price is around $518, property sales in the area in the last 12 months have been $585, and median rental amounts have been $550. So what do we do with all of this information once you've found the property and you know more about it? Well, we'd look at doing an analysis on the property to do a 10-year feasibility analysis to see what our return on the investment would look like. So in this situation, we can see in our first year, based on a 20% deposit and a couple of different other factors like your management fees, annual property expenses, etc. We've got X amount of property equity within our property. So we can see that with a 20% loan or deposit and an interest-only loan, we should have roughly $213,000 in equity within our property. So we're already below the loan-to-value ratio needed to go out and purchase additional property using equity without necessarily incurring any additional mortgages or lender mortgage insurance. So in this situation, we can see that our buying power is roughly around $415,000, and we can see that our net yield per year is around 4.11%. So with that being said, it should be in the positive cash flow section. So what have we achieved thus far? We've searched over 900,000 properties. We've narrowed our search based on our specific criteria, and we've valued the research and researched the property to understand its market value and analyse that particular property. So what I'll do is I will now pass you on to Danielle, who will talk about how we can help you build and manage your property portfolio.
Great, so we can help you to purchase your property via the suite of tools. So if you were to join us today, you would have the most advanced management tools in real estate. You would be able to dramatically increase your results and save hours every week. You'd be able to build a profitable portfolio quickly and easily. And of course, we have our analyzer calculators in the system, so you avoid financial mistakes and take out the guesswork, and you'd be able to plan and succeed. So if you were to get started, also remember you have an immediate advantage of over 99% of current investors in this country. Your subscription is tax deductible. You can also pay within a self-managed super fund, and you have unlimited help and support. So we offer free one-on-one training sessions to the value of $745, and that is for free. So what if you saw the presentation tonight, you loved what you saw, but maybe you're time poor, or you want to do these deals, but maybe you're not confident in doing it alone. Maybe you're not sure about how to identify a deal that's going to be suitable for you. Will you get the right investment property given your circumstances and goals? Is it a guarantee, even though you have these goals in place, that you will purchase a property? You need to think about what are the risks. Are you going to be able to identify potential issues if you're not aware of the signs? So for our clients that are struggling with these things, we do also offer a premium membership. So this is for the hands-off investor who wants an easy way to purchase their next investment property. And we use a 6-step strategic approach. We help first-time investors to purchase their first property and also existing investors to help grow their property portfolio. So with our 6 stages, we would assess your current position, review your finances and put any structures in place, put together a property acquisition plan. We would do all the research and due diligence, so find properties that are going to match your goals and outcomes, present them to you with all of the financials and analytics behind it. Then there would be the stage of property acquisition, so we'd help you to negotiate and go through your first property purchase. And then the property review. So this is where we would manage the property and keep an eye on the market value, look at what the cash flow and equity position is over time. So essentially finding out how the property that's going to work best for you, we would work together with you to determine what your goals are and the investing strategy that you intend to use. So as we went through tonight, would you be looking to boost or replace your income with passive cash flow, even generating equity through renovations, or even subdivisions we can help you with? So we help with existing houses and units within growth markets, so markets that we feel are going to outperform the rest, and also with brand new off the plan apartments as well as dual occupancy properties and duplexes in growth markets. So some of the advantages of the premium membership: you would receive a $5,000 cash rebate on settlements for any off the plan properties that we present to you, and you have exclusive access to stock. You would also get 100% money back if you cannot obtain finance. You'd be able to leverage our experience and our professional ties and partners. These are some recent member purchases that we have offered. So we've had off the plan properties in Gosford, New South Wales, also cash flow, subdivision and renovation examples here within Queensland. Another example of a subdivision deal, so the purchase price was $310,000, so total costs were $400,000. After doing the subdivision, we ended up with $520,000. So in a very short space of time, that was a $120,000 increase in equity on completion. So think about this. Are you working with a well-defined investing strategy? Do you have that in place? Do you have an acquisition plan to find and research your next property investment opportunity? And do you have the knowledge of how to implement your goals to create sustainable wealth? If you would like some help, please feel free to let us know. We're able to book in a free consultation with you, so it's at no obligation, but where we would just find out your current situation, assess where you are at the moment, look at the outcomes that you want to achieve and any challenges that you might be facing at the moment, and how we can help you to purchase properties and advise you of the next action steps if you were to go ahead. So you can see here we've got our membership comparison. So we have our Pro, which is the full suite of tools. So your investor search, your My Research, everything that Tahana went through in the demonstration. And then we've got our Premium membership, where we will do the research and due diligence for you, present deals to you based on your goals. And within this you have 12 months access to the full suite of tools. You would have the 6-stage approach that we would use, also a loan review to get your finance ready. You would have dedicated support to guide you through your purchase and acquisition, and additionally you'd get a $5,000 rebate for any off-the-plan properties that we source for you. So please feel free to let us know if you have any questions. If you would like to book in a free consultation for our free premium membership, you have a free consultation for our premium membership, sorry. We have a link there that you can follow. Also, currently we're offering a special for this webinar for $99 per month on our casual month-to-month subscription. So usually it's at $149 per month, so it is a saving of 33%. Please feel free to get in touch with us if there is anything additional that you would like to go through. I'd like to thank you for joining us on our webinar today, and we look forward to seeing you at the next one. Thank you.